Okay, let's look at the required. For part A, it says you are required to calculate the effect on the taxable income of Patrick Bateman for the 2025 year of assessment of all transactions or events presented. You are required to provide clear references to the Act or explanations for amounts that have no effect. Okay, so remember now what happens with Patrick Bateman. He's this person who has a variety of shares. Some of them are held in his trading portfolios or trading stock, and some of them are held as capital investments. And let's go through it. So I'm not going to write out every single thing. You do have a detailed solution which I did there, so please do go through it. But let's start. So you'll start from the top. This is trading stock, so we'll start with any opening stock. All of these were on hand at the beginning of the year. So what do we use? Remember, for trading stock we usually use lower of cost or market value. However, when it's shares, you must use the cost of the shares. So that is our opening stock. As you can see, the amounts are all the cost. Okay, then number one, what happened? He sold his shares for 208,000 and he received a dividend of 12,000. Okay, so now remember, the dividend, first of all, this amount will be included in gross income, and that is fully exempt then. And then when he sold his shares, he bought the shares in 2020, selling them in 2024, so it's more than 3 years, so Section 9C will apply. Okay, so remember again what Section 9C is. Section 9C says it's treated as if it's capital in nature. So you will calculate capital gains tax on it. Okay, and then you'll see, remember I made a comment here somewhere about Section 9C5 over there. Section 9C5 says when you sell trading shares that were used to be trading stock, and Section 9C applies, so that means where they've been held for longer than 3 years. Section 9C5 tells you whatever amount you claimed as a deduction must be added back. Now for Jasper, we would have claimed that opening stock as a deduction, so you'll see that gets added back. Okay, so here we go, Jasper. So first thing is, those dividends, okay, 12,000 would have been gross income and exempt. They are 100% correct here, or that this was on the 12th of January 2024, so in the previous tax year. One of the reasons why they sometimes give you the dividends here is obviously to try and trick you, so that you put it in now, but also if you are looking at the dividend stripping paragraph, you consider the dividends that you received within the last 18 months. But let's go. So sale of shares. Section 9C applies as capital in nature. Gives you a mark, say it. For Jasper, we deducted 225 during this year. So see there we added back 225, Section 9C5. It's in a sale. Proceeds, the actual selling price, base cost 225. Now, we made a capital loss here. Now remember, whenever you make a capital loss, that is when you sell the shares or when there's liquidation you make a loss. When you make a loss on the selling of shares, you have to consider paragraph 19. Paragraph 19 is the dividend stripping section. This section says the amount of loss, because remember this is now our CGT column over here, right? So what we want to do is we want to put that loss into our CGT column like this so that we can use it against capital gains. The amount of the loss that you are allowed to claim is the amount which exceeds, okay, and I'm just going to write it quickly here. Paragraph 19. So I'm saying the capital loss that can be claimed is the amount which exceeds exempt dividends or the extraordinary So okay, let's make the next comment first. This is for liquidations this side, and this is all other situations, which is what we're looking at now, because we just, in this case, selling the shares. We didn't receive it for liquidation, the money. Now, an exempt dividend is exempt from income tax, and that's under section 10(1)(k) plus dividends tax. Okay, so for example, if a company, as a shareholder as a company, there will be no dividends tax. Remember, there's no dividends tax between companies, so that would be exempt. In this case, Patrick's case, it would have been exempt under section 10(1)(k), but it would not have been exempt under dividends tax. There would have been dividends tax on the amount. So his exempt dividend would have been null. An extraordinary exempt dividend is the exempt dividends, which is what we got here, less 15% of the proceeds amount. Now, in this case, the extraordinary exempt dividends would be, he would have, so you look at the dividends that they received within the last 18 months, which would have been that 12,000. That 12,000, how much of that would have been exempt? And when I'm talking about exempt, I mean in terms of paragraph 19. Null would have been exempt. Null rands. Because it was exempt under section 10(1)(k), but it was not exempt under dividends tax. It would have been dividends tax. So that means the extraordinary exempt dividends is null less 15% of the proceeds, which is that amount. And it can't be a negative amount. Right. So it's just null. So because that 17,000 exceeds null, now again guys, remember, I know a negative 17,000 is less than null, but we're just looking at 17,000. How much of the 17,000 is above the loss? Of course, everything is above it. The full amount is allowed as a deduction. So this was a simple one. Paragraph 19 is 1 or 2 marks max, so it's not the end of the world, but I am just pointing it out to you. If you don't know what I'm talking about, guys, here, please, you have to go and look at paragraph 19. Okay, so that was Jasper. Then we have this Gertha, number 2. So what happened to Gertha? Gertha is the one where it was transferred from shares to trading stock. They had also held it for more than 3 years. I remind you again, usually when trading stock becomes capital, you recoup the market value under section 22(8). But because these shares were held for more than 3 years, and it only works with shares like this, section 9C5 would have rather applied. When you then sell it, you will use the original cost as the base cost and the proceeds. So let's go and see here. So yeah, transfer of the share. So usually you would apply section 22(8), but section 9C7 says if you've held it for at least 3 years, you don't apply section 22(8). You just apply section 9C5, which is adding back the amount, 120,000, which is the same as the amount that was claimed as a deduction. It's the same as this section 9C5 principle that we see here. Okay, then there's the dividend that we received. There we go. Okay, so again guys, remember the gross amount. Number 3, this is the Floro shares we held from 2023. It says Floro made a distribution to its shareholders. He received 5,000. 2,000 of this was contributed tax capital. So remember what I said to you, it means 5,000 we received, 2,000 was contributed tax capital, 3,000 would have been a dividend. But this is the amount that he receives in his bank account. So that 3,000 is after dividends tax has been withheld. Remember, there's no dividends tax on contributed tax capital. That's one of the important rules. So that 3,000, the amount before tax is 3,000 times 100 over 80, 3,750. So here we go. The return of capital at 2,000 is gross income. Remember this whole discussion I had here? If you receive contributed tax capital, if the shares were trading stock, it's gross income. That's what we're seeing there now. And here's the dividend that was received. Then they also tell you the shares are still on hand at the end, so you add back the shares at cost, the closing stock. Okay, now we have ASPERS number 4. So yeah, this is where you became entitled to a gross distribution of 30,000 gross, so that's before dividends tax. 8,000 of that is return of capital. So again, then we went and we said, okay, if you receive a return of capital, contributed tax capital, and you held it as capital, the shares, which is what the case is here, what do you do with it? You will have to apply paragraph 76B, unless it's a liquidation, when it's treated as a disposal. This is not a liquidation, so you apply paragraph 76B. So what does paragraph 76B mean, guys? Well, first of all, here's the dividend amount, gross income exempt. Return of capital, paragraph 76B applies. So you take the base cost, you deduct the return of capital, and that gives you an adjusted base cost. See that we don't do anything with it over here. It just reduces the base cost. In this case, I take it one step further just to show you what happens, where I tell you he then sells those 300 of those shares. How many shares did we have? 500. So he sells 300 out of the 500. The base cost of the shares is 17,000. Okay, so that's what the base cost would be for 300 of the shares. And that gives us a capital gain. And then we have Jules. Okay, so Jules, a number of things happened. So with Jules, the first thing is, on the 1st of April, they decide to transfer the shares from the investment portfolio to trading stock. They had a market value of 90,000. So remember, if you take capital and it becomes trading stock, paragraph 12 says you are treated as if you sold it at its market value. So there's a disposal, CGT. Section 22.4 then tells you you're treated as if you purchased it as trading stock at its cost. Alright, so there's our disposal, proceeds, base cost, gives a capital gain. We then treat it as if we purchase it. So you can, this is section 22.4 for its market value. They then tell you that they then have a share split. For every one share is split into 10 shares. Okay, so what happens for tax purposes? Nothing. Can you see? Because we didn't get value, we just have extra shares, but we also, the value per share is less. So we still have the same value of shares. Then we buy an extra 150 shares at 210 rands a share. Remember, it's now trading stock, so we claim the trading stock deduction. And then they sell you, sold all of the shares at the market value of 240 per share. So how many shares did you have? You had 50 originally. Those 50 shares were then split into 10 shares for each share. So you went 50 times 10 equals 500. We then bought an extra 150 shares. So we sold 650 shares times 240 rands a share. Okay, we add up all of our CGT. Annual exclusion 40,000. Be sure to go all this way, guys. There's usually a mark there. This annual exclusion, remember how annual exclusion works? It reduces your capital gain. Can't make it a capital loss, so it reduces it to null. If this was a capital loss like that, it would have also reduced it to null. So what I'm trying to say is, if you have a capital gain or loss, let's say, of 60,000, well, let's do it like this, a capital gain of 60,000 or a capital loss of 60,000. The annual exclusion, just a quick reminder, works both ways. So for the capital gain, it will reduce it from 60 to 20, and the capital loss, it will reduce from minus 60 to minus 20. So it excludes amounts, it's not a deduction. Alright, that's it.